What is going on, everybody? Welcome back to another video. I know my face, if you guys are seeing this, looks a little weird. I have an earache right now and it's killing me. That's what's up with the sweatshirt and the headphones. So with that being said, guys, this video is going to be about exactly how I have outperformed the market this year by a ton. I don't remember the exact, but I've also done it with very, very little risk. And I want to show you guys exactly how and the exact strategy that I have used pretty much all year to create income, and I've gotten growth out of some stocks. And I want to explain how I've done this. So, a lot of people have heard about the wheel strategy and things like that. I do think that this is a great strategy. Now, I'm bringing up TQQQ, and you're going to instantly say, hey, this is $44.43. Well, that is true. But at the beginning of the year, it was $17, and I was killing it on this stock. I have multiple friends that did this exact same strategy with me, and we all absolutely had crazy results. Now, I am the only one, it seems like, still, over the past 3 months up here at these prices that I'm still running this strategy, and I'm going to explain to you why some of them have backed off of it and moved to different stocks, which there's no problem with that whatsoever, but you will see the insights of it. So, with that being said, let's cue the intro and dig down deep into this one. Okay, guys, so, again, we have TQQQ up here, which is basically the leverage, and you guys see it says leveraged right here, and it'll explain what leveraged is here on Robinhood. So what we're going to do, and I'm going to actually go to a company that's much cheaper and something that you guys can do this on, and a company that I would not do this on, and I'm going to explain why. It's a Ford. Guys, Ford has done absolutely incredible things, and it's a name brand. If people are either Ford fans or they're GM fans or they're Dodge fans, it's a car thing. It's a truck thing. It's, you guys all have your brand that you grew up with. For instance, my family did drive Fords. And this is a stock that's really cheap. But I say that as in the price is cheap. The barrier to entry is cheap. Overall, I'm not a huge fan of this stock. I'm going to be 100% honest with you and want to make sure that you guys are seeing this. And because I have both of these up, we are going to type in Ford Motor Company, and I want to zoom out as much as possible. So you're going to see they really haven't been, doing anything fantastic. They did in the 90s. The 90s and the late 90s, they had fantastic run-ups, and really they haven't done anything since. And so we're going to go back here. And I do a daily chart, just so you guys all know. I stick to this pretty much for all my long-term accounts and just pretty much all my accounts. So, but what we're going to do is we're going to zoom in here and we are going to look at these. So we are going to use options in this strategy. So, trade F options. And again, I use my Robinhood account just to show you guys and do videos on this. I don't actually mess with it unless I'm doing just little accounts I'm trying different things on. And for me, I'm okay with going 27 days out with like TQQQ in the actual markets and indexes and things like that. It's normally okay with me. And actually, I would probably on this one, if I was trading TQQQ, I would go 41 days out. Now, we're going to explain why though. And I'm going to go to a put because this is going to be easy, and we're going to sell. We're not going to sell. Now, again, you guys are going to need some collateral. So you guys are going to need roughly $1,000, maybe a little bit more. Now, here's the problem with Ford. There's no movement. And when I say that is, your probability here is chances of profit are almost 80% for $15 for 41 days. To me, that doesn't really interest me. I can go run a credit spread on SPY for that. So, now I am interested in weekly income. Now, here's how you can do this on some of these stocks that are not as reliable, but again, you can get caught in these. And this is why I don't personally do it, but I do know people that do it, and I have done it in the past. And again, it's just never worked out long-term for me, but short-term, you can make good little chunks of money. So, for me, $1,050, I can collect 12 cents. Now, if I get assigned and next Friday, I'm going to have to buy this at $10.50 per share, 100 of them. So that's $1,050. Now let's go back, and this is why I pulled up this. Do I want to buy this at 10.50, and do I think it's going to stay above 10.50? Right here is 10.50, where this little dotted line is. Do I want it at 10.50? Because to me, I could see it. It just had this gap down. I think it could possibly go lower, but this is the strategy that you can use if you have very little money, or you have $1,000. You can get into this trade pretty much with $1,050. You're going to gain $12 a week. So what you're going to do is you're going to sell this. You would hit continue, and then if it stays above 10.50 for the week, you're going to collect the $12, and you can roll out to the next week. And basically, you're going to get pretty close to the same every single week. And again, Ford has weeklies. And again, see, you can go out 2 weeks. Now, if you think Ford's about to go on a bull run, you would sell these. But to me, I don't want that. I don't want it at all. So what am I going to do? I'm going to stay where I'm at right now. But for instance, instead of doing this trade, it's because anybody can do this trade, I would rather see you guys go out to trade options, go out 45 days. And again, I like 30 days as well, but a lot of times it's 45 days. And if I can't find that, I go to 41. And this is the big difference here. I'm going to show you guys this because I would rather see you guys do credit spreads on these than doing a put on, excuse me, on Ford, because it's just less risky, to be 100% honest with you guys, mathematically too. And you're going to use way less capital, guys. I'm probably going to show you a trade here where you're only going to need, you can use either $1,000, or we'll show you one where you can use half that, $500, and get into a trade, and you still have $500 risk-free, and your probability is super high. So I like to sell a 15 delta. You guys don't even need to know about that. Know what that is, but just 85% probability of success rate is what I'm looking at. So I'm going to sell this, and then I'm going to go, and again, this is not exact numbers due to the market being closed already, but I'm going to go 1, 2, 3, 4, 5 out, and I'm going to buy this. Now, you guys are going to see it's about a $50, $46 in spread, and my max loss is $452, guys. Why wouldn't I take this trade? Now, here's the even bigger difference. It's a $440. Now, move this all the way up. That means the market's not going to come all the way down to $440 before you're doing this. Now, would I recommend this trade on this day when the market just had a huge green day? No. I would be looking for one of these red days, even if it's not a gigantic red day, because the SPY can cover this in a week. If we were having a really, really bad week in the market, SPY can cover this. But if not, and we're just kind of having just a normal, consistent market, like right in here, for a month, you guys can see this is 2 months long of just back and forth that you could have just easily made profit. But a 440, you can do this, and you can end up rolling it out, but that's neither here nor there. That's way more advanced. But I would be looking for a red day, just a simple red day, and I got a feeling you can get out to about 435, and that would make me feel safer. That's an extra $5. I probably gained the same credit, same risk of capital, and I'm getting $5 further out. To me, that's worth waiting a day or 2 days, depending on where it's at. Now, again, am I going to hold this till expiration date? Because everybody that sells puts and options in general thinks that, you have to wait for expiration date because I need to max out this $46. I want all $46. No, guys, if I'm in a credit spread, I'm not waiting till day 0 unless, I can't even think of a reason on why I would do that unless I'm just super busy and I forget about this trade, which is not going to happen because this is my livelihood and how I make money. So $46? No, I'm not. I'm going to collect this credit, but if the market continues to go up, I'm going to get out of this trade. I guarantee you I am only going for half profit. So I'm going to look for a $25 return on this. And my computer is just going crazy now. So $45, why would I do that? Well, because it's going to take forever to decay the rest of the way. And a 10% return on $500 is $50. So what does that tell me? You're going to get half that, and you're probably going to get it in half the time. So which means you can still make that same return, just closing the trade, collecting the profit, and say the market comes down in the next week or so, boom, I'm able to get further out. So now instead of selling this one or this one up here, I'm going to possibly get out here at let's say the market has a real bad day. These will become worth way more. And guys, you guys can do this too. I used to do this. It's 10% probability of actually getting hit, so 90% probability of winning. Buy this or sell this one, this 430, and you can buy this one. Now this one's going to take more money. You can see the max loss. So I wouldn't want that one. But I can always go out here. See, this is $1,000, and I'm still going to make $42. Now, why is that? Because you're getting further out, and the math has to add up. We're not going to go into that in this video, but that's why it's what's happening. And again, we can go over here, 22 cents for $500. Now, you have to wait for the whole 41 days, so I'm not personally doing that. But you're getting out to the 430. Again, that's even further out. Look at that. 430. It's actually 50 cents less than that because I'm at 41. There it is. Now you have way more room to play with in this. And I have a golden rule. And again, a lot of people actually have this. And I think it's a staple to have when playing these credit spreads. Now, if you're doing just the naked puts, I will buy the shares. I will hold the equity and start doing covered calls, which means you're just going to own the shares and sell a call above your basis. Guys, that's a very simple thing. There's a million videos out there. I have videos on it as well. But on these, the golden rule here, and if you've stayed this far in the video, is you guys are going to get is if my credit is $22 or 22 cents, $22 is what it's going to be, is I will not let it go past 44 then. 44 cents is my max loss. So what does that mean? Is I double whatever my credit is, I'm going to double it, and that is going to be my max loss. So worst case scenario is I'm going to say in my terms is I'm going to lose $50 on the chance of making $22. Now you're going to be like, that risk reward's awful. Yes. But my probability of winning is super, super high. And I think that's what people are forgetting. Don't let one trade kill you. Because I see people all the time let these go all the way, and they're like $1 away from their strike price, and the option's worth way more, and they're just hoping that it expires so they collect all $22 or $50. In this case, it'd be $22. Don't do it. And this is not financial advice. This is me just doing this so many times that I know better. You learn from these things, and some people have to learn the hard way. I get it. Don't be one of those people. Learn from the advice of other people. And again, this is not financial advice. I am not an advisor, but I do this on a day-to-day basis, guys. This is how I make my living. These are the rules that I have created for myself after making every mistake in the book. Make your stop loss the max credit that you can make, and then double it. Double it, and then that is your stop loss. You don't have to put in a manual stop loss, but know in your head, write it down in a spreadsheet. That's what I do. I have a spreadsheet. And then make sure that that is your max loss. If that's your max loss, you're not going to get hurt near as bad. And not only that, then you can go and play different things like futures. You can indexes. There's tax purposes that are behind that. But again, don't worry about the taxes and things like that until you start making money. Number one key thing here, know what your probabilities are. And I hope this helps somebody because I have multiple friends doing this. This is a way to create income without risking a ton of money and being in some other risky stocks and things like that. Guys, nobody wants to own Ford. Why? Because Ford doesn't know what they're doing. And this is just the example. Again, I'm not buying Ford because anything that looks like this on a chart over the past decade is awful. I don't want to own it unless I think that there is an insane comeback coming on. And I don't. If I'm going to go buy an automaker, I'm going to go buy Tesla, even though it's had such a run up, because I believe in Elon Musk way more than I believe in the Ford family. So, that being said, guys, thank you guys all for watching. I hope this helps somebody else out there. Again, if you need to do more research and more in depth, comment below. I will help you. I have a ton of videos on these things, and we will go from there.